Global stocks selling off, bond market selling off, oil back above $100 a barrel, US dollar rising as a flight to quality. We are seeing what I believe is the war trade. What is the war trade? Let's get into it. Okay, welcome back to the channel. Welcome back, Clifford, with another Sunday night futures market open. And what a week it has been. So for those who were not watching last week, there were some significant developments that took place. You know, the S&P 500, as I had mentioned in last week's video, we were watching for a break here at 66.39. Strong close below support here. Strong rally back to resistance, but couldn't hold. Next leg down. I believe we're going to get another leg back up, and I believe they're probably going to sell right into that strength as well. So be on the lookout for that next rally. And we have oil back above $100 a barrel. No surprise there. We know that the conflict was continuing. So let's see what we have this week happening. This is a big week. If we look at forexfactory.com, we see Monday, Fed Chairman Powell is going to be speaking. That's definitely going to probably be significant. So we definitely want to hear what he says. Over here on Tuesday, we have the Canadian dollar GDP. Anyone who's a Forex trader definitely wants to watch that. Jolt jobs openings, you know, number of job openings for last month. That's could be significant as well. I would definitely keep an eye. Consumer confidence, just a lot of different stuff happening next week. Then we got the ADP non-farm payroll exchange. This is kind of like the preview for the employment report. Retail sales, that's going to be big because it's going to show us how the economy performed last month, as well as ISM manufacturing. Finally, the granddaddy of them all on Friday, the non-farm payroll. They're expecting a gain of 56,000 jobs for last month. We'll see how that comes in. And of course, the unemployment rate there. All right, so that's what's on the schedule for next week. So let's take a look at the markets here because, again, a lot of things were moving the market last week. And let's talk about how this war is affecting the market. I believe we're seeing right now the war trade. And for those who don't know, there are two basic types of markets that are basically at any given time, the market sentiment of the market can be in two different ways of trading. One of them is called risk appetite, where investors are basically buying risk assets. You know, they're buying things like stocks, right? Stocks are considered a risk asset. They're buying commodities, that could be a risk asset. They're buying Bitcoin, right? They're putting their money where, you know, taking risk. And then the opposite of that is risk off. So you got risk on, risk off. But when it's risk off, it's called risk aversion. That's when they're not buying those riskier investments. They're trying to place their money where they feel it's safe. So, and right now it seems like that is the US dollar. The US dollar is rising ever since the beginning of the year, and now it's broken above resistance. But what we're really experiencing is kind of like a flight to quality. Sometimes they'll flock to different asset classes, like, you know, maybe gold, although gold was a flight to quality, it looks like, earlier in the year, but it kind of just, you know, they took profits. I believe that eventually probably the inflation hedge will start to come back. So let's see how the report was, how the investors right now are positioned, because if you're not paying attention to the COT report, you're basically trading blind. So you want to watch this every Friday. So let's see how it looks. So here we have the Dow, and as you see, they were very short. They were short the Dow, 21,000 contracts back in November. They started to get more neutral. Now they're starting to sell again. On the S&P, they were short earlier in February, but as you see, they went from 196,000 contracts short. They started closing those short positions, right? And now they're only 79,000 short. Now, usually what they do when you see the market rallying, usually you see them shorting the S&P as the market rallies. But this time they're buying the S&P as the market is falling. That's a sign that they may not they may not be getting bullish again, because usually the COT report works as kind of like a contrarian report, meaning like if you see them really short, you used to kind of like they would get overextended shorts, and then basically you would see a move to the upside because they were closing those short positions. But now we're seeing something different. On the NASDAQ, it looks like they're kind of long here, but they kind of closed out some of their longs. Another thing that this does, the COT, sometimes it shows you when they're increasing their positioning to the downside. So like here, you see the break in support. Usually if you see, like let's say you see them neutral, like let's say you see them at zero, but then you see a huge jump in short positions, that's a strong indication that they're moving back into that they're selling into that sell-off, you know? So basically you'll see them sometimes buy into the sell-off, and other times you'll see them sell into the sell-off. But right now, it looks like they're continuing to buy this sell-off, which is usually not how it goes. Usually they continue selling the sell-off. So that's something I'm going to keep an eye on. Over to the Russell, you know, they're kind of they were a little short here, and this is what I mean. It's a contrarian report because see how here they were really short, and then they unwound those shorts and the market bounced. That's typically what you see. Like they get really short and then they unwind the shorts, which causes the market to catapult to the upside. But we'll just have to see how that plays out. Over to the commodity side, however, we have oil. And this is another way you can look at this report. Like here, they were 56,000 contracts long, and as you see, now they're getting longer and longer and longer, 80,000 long, 98,000 long, all the way up to 172, 221, 240. So they're increasing their long positions on this rally. That could mean that it's getting overbought, but not yet, because as you can see throughout history, this thing has gotten up to 736,000 contracts long before they really, you know, got overbought. So I think that we're kind of like in this environment, we might see a pullback in the oil market, but I believe the dip's going to be bought at the moment, at least, unless tensions change. Over in here we have the let's see what else we got here on the currency side. This is one thing I'm watching. See how short they were the US dollar here, negative 16,000 contracts short, and we saw the catapult unwind a little bit. Now they're kind of neutral, but look, they're starting. See here they were neutral at about, you know, negative. Oh, and sometimes I'm sorry, sometimes you'll see a flip. You want to watch for the flip. See the flip from negative to positive. They were 62 negative. They were short 6,000 contracts, right? But now they flipped long 4,000 contracts. You want to watch those flips because a lot of times that can indicate that the institutions and the big banks and the, you know, large institutional investors are buying into these markets. So if they're buying the US dollar, then that's basically a safe haven because usually when you see oil prices rise, you usually see when commodities are going up, usually you see the dollar fall. But that's not what's happening in this environment. They're flocking to the dollar. Could be because the dollar is still considered the world's reserve currency as well. So the war trade, in my opinion, right now, this is basically what we're seeing. It is, this is the war trade right here. I'm going to show you that. Okay, selling stocks, right? Short the stock market. That's basically what they're doing. Long oil, right? That's the second part of this war trade because we know the Middle East conflict. They're long the oil market, right? Then long the US dollar, right? Because as we see, they're getting long the US dollar. And finally, they are also shorting the bond market. That's the war trade right there. So it's basically long commodities, long the US dollar, short the bond market, short the stock market. That's basically what we're seeing. That is the war trade. Now, the real question is how can we either protect ourselves from more uncertainty, or B, capitalize on a trading opportunity in this environment? Well, in my opinion, there's one of two ways. You can definitely, me personally, I'm a trend trader, so I'll be watching for the S&P this week to to hit that retracement rally. I believe that eventually they're going to take profits from the short positions. It'll probably cause the market to bounce. At least I'm going to say the best place to sell it if you're going to take a short position on the S&P would probably be at the trend line right here. I'm using this trend line as an example. But if I didn't use this, although I like to use the trend lines, you could just use a resistance level. And if you're going to do that, I would say it would be this one right about, let me see this one here, about 6,500. That's a psychological level. But me personally, I would wait till it rallies back up here to 66.20 if you're going to enter a short position. That seems like a safe place to do it because 6,600, 6,620. See, it's right close to this trend line, and I'm only going to risk 50 points, right? If I get stopped out. But as you see, the downside will be at least 2 or 3 to 1. And if you're saying like, well, how do you know the S&P can bounce like that? Oh, it could definitely bounce like that. Look at this move right here. This was like a 250 point move to the upside in just a day. What is that, like 2 days? So it could definitely rally back to the trend line. And in a downtrend, you want to be a seller. If you're bullish the S&P, I wouldn't consider buying it. I mean, if some investors believe in buying the dip, but I don't know because that's a little dangerous to me because if the market rallies, which we know that profit-taking rally eventually will happen, when it does, you could get caught in that rally and caught in a sell-off on the downside once the downtrend resumes. You could kind of get caught there. So just be careful, use risk management if you do decide to buy the dip. You know, I would say target a profit zone back to the trend line. If you're gonna trade counter trend, target a profit zone back to the trend line. But if you're gonna short it, again, I would wait till you get about up here at 6,600. That should be a safer place. And then the other thing I'll be watching this week is, because we're in the war trade, not only is it long oil, but it's long other commodities like food. There's a lot of agricultural stuff going through that Strait of Hormuz too, fertilizer and corn and wheat and soybeans. And I watch these grains, and as I keep watching them, I believe that if we continue to see oil prices rise, I believe we're also going to see corn rise, soybeans, and wheat because they're using corn for the ethanol and that's part of the gasoline and all that stuff. So I've been trading it since back here on March 17th. I bought one position here, had a stop loss down here, bought the second position here on another pullback, put my stop to break even. And right now I'm pyramiding it. I have about 2 small positions in corn. And what I like to do is I like to wait for a break above resistance. If we get a break above this resistance level here at 475, I would buy the next pullback and pyramid again. I'll make another video in the future to show you how the pyramid trade works. It's one of the best ways you could double or possibly triple or even quadruple your profit potential while only taking a minimal risk. Like you buy one position, but then when the market moves in your favor, you start buying more positions, but you just move your risk slowly to protect that other position. So again, we got a big week ahead of us, guys. Just whatever you decide to do, if you're going to wait on the sidelines or if you're looking to, kind of hedge yourself a little bit, just use risk management as always. And again, if you're going to play the war trade, that's the way to do it. It's basically long the US dollar, long the oil market, shorting the stock market, shorting the bond market. Now, again, these are not trade recommendations, of course, but this is the environment that we're in until something changes. And again, of course, obviously, political things can change that on a dime. President can come out, tomorrow and change everything around, right? So you always want to use risk management. But in summary, as far as what I'm doing this week, again, I'll be watching for that that S&P 500 retrace back up here. If we could get in here, like that 6,600 level, I'll be shorting that, putting a short, maybe a small stop above resistance here, me personally. Again, not a trade recommendation. Always trade at your own risk. But I'll probably put like maybe, I like to sell as close as resistance as I can. So maybe if I could get up here like 66.25, that'd be perfect because then I'd only risk like, 75, 50 points and then target those lows in the future. And then the other trade I'll be monitoring this week is that corn trade, which I'm still holding for now, and we'll see what this happens. Worst thing that happens if the market reverses and I get stopped out here, then I would have broke even, and I only would have risked that first position. But if it moves in my favor and continues to move in my favor, we'll see how far this pyramid could go. Again, I'll make a video about that in the future. And the last thing is, if you're watching the Forex market, on a break of this resistance level, it already broke it once. The dollar's already back above here at 100. If we get a second break above this resistance level, let's say for some of these economic developments this week, then I would definitely be willing to short currencies against the US dollar with a small risk management position on a retrace back to that support level here at 100. So that's about it for this video. If you guys like the video, feel free to like, subscribe, put your comments below. Look forward to seeing everyone in the next one. And as always, use risk management. Never risk more than 1 to 2% of your account on any given trade, whether it's private trading or you're using a prop firm account. It's the best way to survive trading in the long run. And have a great trading week. Be careful. Good luck, guys.